So, great segue about really why we do what we do. As I said to everyone, when we do trainings, when we meet you the first time, everyone has a self-interest. And in shared ownership, our self-interest has to be a collective one. Because without a collective interest, and we carry ourselves as though these units are our sole fiefdom, we forget that there's things putting the units together or holding them together, be it the ceiling, the floor, the walls, right, and the infrastructure. And what we try to make sure happens with Center for Shared Ownership when we collaborate with another group is that one of the key self-interests is that you want for your property, your association, your corporation as a housing cooperative to be able to compete in the market that it is, while ensuring that the legacy residents are not displaced, right? And so, how do you do that? And tonight's session really is about that balance, right? I tell most folks that when people buy into condos, they buy into condos or into a co-op at a certain income. They may be working or what have you. But now they've moved on to retiring. And then as they retire, their income becomes steady. Well, we got a plan from the day they buy that unit as a community to that moment of retirement. Hopefully, they stay with the community that long. Or better yet, they've had the choice because the property, the asset, has been managed in such a way that they can collect wealth, right? Or it becomes a legacy equity wealth investment that moves on to family members or whomever else. So we want to make sure that these properties last, not just for the today or the present future, but for the legacy future as well. And many of the properties we're working with are properties that have had their time in the sun and they've aged like many of us are aging. They've got some creaks and cracks. And if we don't take care of it, if we don't, my first husband, anything wrong with something, get some DW20. I have no idea what that is. I learned it was oil. Put some DW20 on the door, right? Well, it needs some TLC and as much DW20 types. This property is a living, breathing thing, not only because you as human beings are utilizing it, but because it too has its growth and aging and needs revitalization and restructuring at time. It's never perfect, but what will be at its imperfect perfection is the ability to get to the dollars a cents of day-to-day maintenance and management and the dollars and cents of long-term expectations and planning. And how do we do this? Most of these properties don't have outside income coming in. It is you as shareholders who funds this. And if you don't fund it well enough, it will show itself as not well funded. But if it's funded well enough and it is cautiously taken care of, then this property becomes that investment legacy, not only for yourselves, but again, for family that you may leave investment behind for, and or you now have choice to transfer it, to sell to another buyer. So this is our self-interest because we know that the more homeowners we're able to keep in their homes, the consequential effect is that you're not in the rental market and therefore there are rental units because as we all know in the Chicago area, there is a great gap of affordable rentals. So that way we're hoping that the market opens up to more affordable rentals. And for shared ownership, when a shared ownership property is deconverted from its shared ownership purpose, 9 times out of 10, it becomes a high rental property. It doesn't go back to home ownership. And it's not one owner that we're losing to the market. It's a multitude of owners, 6, 10, 60, 500 owners within our community that we're losing. And so our action to preserve and make sure that it is a strong opportunity for us to say, this is the time to revitalize, or this is the time to plan so that we could get to revitalization, we believe is now, not tomorrow. And this is why we do these workshop sessions. And this is why we work with those that we work with to see where we can help them find not only resources, but to also help them gain knowledge, relationship, understanding, so that that group of people that's your board today, we're not looking around 10 years from now and they're the same people being on the board. Being on the board is hard as it is. You all have your own lives, your jobs, your children, your families to deal with. And on top of that, I tell everyone, being on the board, whether you think it's a good board or not, is the most highest level of engagement possible. And it is the most thankless job in the world. I thought being a parent was a thankless job. Nope. A board member of a cooperative or a condo or a townhome association is the most thankless job there is. But your boards stay on and carry on. And so for those of you that are here today that are board members, thank you, right? For those of you who are not board members, learn, participate, engage in your committees, read the information. Your board members are no less human than you are. So they can and will make mistakes, but you need to work with them. The last thing I want to say is I see some of our collaborators who are at the crossroads of tension. Let me say this is not a forum for you to find answers to your problem. This is a forum for you to get new insight, affirmation on things that you think you know, and confirmation on new learnings that Eleazar will bring to us. And tonight, we really, really hope, again, tonight's not going to teach you everything, but tonight would at least, what we hope is that you're going to leave with more questions than you came in. Why? Because when we learn, we ask the question, really, is that the only way it can be done? Oh, so why is it done that way? And then it moves to more questions that enlightens and opens our insight. When we speak today, we're not just talking about the shareholder or the member. We are talking about, when we say income, we're talking about the income that the collective body put in to do that asset management, to do the maintenance plan, to keep the building looking good so that if you choose to sell, right, you're selling and can compete with the rest of the market in your area. So when we talk about the property, remember, you are the heartbeat of that property. You are what provides the income to maintain that property. And it is your income that is the investment that funds your asset management. And some of the things we're going to say to you today, you'll be like, not in my property. Well, then you need to decide if your property is going to compete in its market and stay and have the ability to do so, or do you just want, shrimp at the cost of chicken? Don't work. You'll get fake shrimp. So that said, I do ask again that for those of you that are here, and you know who you are, and that we are working with you through some very tenuous situation, this is not the place nor the room for those tenuous situations to come up. Be clear about your questions. Eleazar is one of our expert consultant who has taken time to do this workshop for us. And we will also tell you of another workshop he did that I don't know if Dana will be able to put it in the link tree so you could look at it as well. We did a lot around asset management. I think it would be a good compliment. And to that, I say, welcome, Eleazar, and thank you for being here.
Thank you, Janae. Oops. There I am. All right. Well, thanks. I enjoy being here. I enjoy, working with everyone here at CSO and CRN. So today's session is really going to focus on budgets, right? Creating a budget, what goes into a budget, and some solid tips, right? I'm going to show you a couple of an example of an operating budget, as well as looking at replacement reserve and replacement reserve account, which is typically used for capital improvements. Now, Dana, do you have the presentation to share? There we go. All right, and it includes, it's a budget is a big part of the management of a property, right? You can go on to the next page. Right. And really the budget is a tool for the fiscal responsibility of those in charge, right? So the board of directors, right? Your HOA, you're acting as on behalf of the owners. So you're acting as owner's agent of all the owners, right? Not just of yourself as an owner. And the responsibility is for, sound financial management, opening bank accounts, paying vendors, making sure that things get done on the property, and accurate reporting back to those owners, right? What happens with all those funds? What happened to all that was collected? Where did it go? How was it spent? How much is left, right? And separating those funds, right? Not combining, not commingling personal accounts with, accounts of the association, with accounts of the co-op. So it's a big responsibility, right? It's a fiscal responsibility of keeping track, not just keeping track of the funds, but keeping track of the records of the vendors, and everyone that you're working with, and being responsible and accountable to the owners. Next. So an operating budget, right? It's a tool. It's used, right, to lay out your income and expenses, various types of income. And, in this case, it's going to be mostly the dues from the owners, but there could be miscellaneous income that comes into a property. The simplest one could be something like, a vending machine in the lobby that perhaps generates income. You tracking your expenses, utilities, insurance, property insurance, liability insurance, payroll. Do you have any staff, or is it all vendors? And the vendors, right? The vendors are expenses. You're paying them to provide a service. It's easier to see the trends at the property on a year-to-year basis, on a quarterly or even a monthly basis. How much, are we spending? Is our gas bill higher this month versus last month? Right? Going from December to January, spending more on gas makes sense. But if you see that your gas bill is going up from July to August, what's going on, right? You're able to see problems, notice situations that need to be attended. So you as well, to determine those unusual or non-recurring, other items that come up. It's a means to track the performance. Are we on track? Are we, on budget, right? On time and on budget, or are we far off? The budget will indicate, right, the money that's projected to come in and money that's projected to be spent. You can examine the deviations and variances, those changes, right, to current or future budgets. And, as if you know that your utilities are going up, Well, now for next year, you can expect that they'll probably be even higher than they were this year. So it allows you that opportunity to start planning, for those changes. And it's to help you be prepared for financial responsibilities. How much are you putting aside for, for certain items, for repairs, for capital improvements? Because kind of saying, we'll deal with it when we get there. We'll deal with it once, when we have to change the carpeting, when we have to, replace the boiler. That's not a good system, right? Having that budget and preparing for those items, preparing for that financial responsibility, that's the job of the budget, right? To help you see those things, to help you forecast those things. Next. Okay, so on the revenue side of the budget, right? It's the revenue, it's the potential income that's coming in. Perhaps there's a vacancy, you have to account for that. Other income, like I mentioned, if you have vending machines, laundry, perhaps you have a bank account that's earning interest, primarily with a co-op or with a condo association. These are going to be the dues, right? These are the fees that the owners contribute, right, towards the maintenance, towards the upkeep of the property. That's going to be your primary revenue source. Next. Right? And then expenses on the expense side of the budget, right? Anything as administrative. What are you, office supplies, perhaps paper, copies, maintenance and repair, your daily stuff or your seasonal items, right? Anything more than a plug toilet, you may need a plumber, right? Your landscaping, is that something assigned to perhaps one of the owners, or do you get a vendor for that, right? And how often, what's the service that they're providing? Utilities, common areas, where somebody's got to keep up with that electricity for the hallways, for the parking lot, for the entrances. The elevator, if your property has an elevator, right? That's an expense, the monthly service to the elevator. God forbid you have an accident because no one ever took a look at that elevator. Scavenger service, which is your rubbish removal, your waste management, to take care of the dumps, to remove the garbage from the property. Taxes and insurance for the property, to cover the owners as a whole. The legal and accounting services, right? Depending on how sophisticated, or if it's a much larger property where you may need outside assistance, either legal or accounting services. Debt service, is there a loan, principal and interest, or actually just the interest is counted as an expense, not the principal. But those would be expenses. Other items, right? And things that come up can be also included, once they're spent. Once you get to there, those go in under other if you did not have those items forecast. Next. Part of what risk management is going to be one of the expenses. And what are we talking about here? We're talking about insurance, right? That's going to be one of your big ticket items on your expense side. And what insurance does is you're mitigating the risk. You're sharing the risk actually with the insurance company, right? Because if you have something that's a risk or a hazard or a liability that could become a hazard, what can you do? You can accept the risk and say, like I said before, right? We'll deal with it when something happens. Not a good idea, right? You can avoid the risk, right? Just kind of eliminate it altogether. And I like to give the example of, providing a Head Start program in the building, in the property, right? It's a lot of liability. There's licensing requirements, and there's background checks that you have to do. And if that's something that you really don't want to accept the liability, the responsibility for that, you drop the activity. Otherwise, you prepare, your licensing, you prepare everything, you get your liability insurance, and you cover yourself, right? Otherwise, you drop that activity. Accept the risk, drop the activity, just avoid it, mitigate the risk, right? Do what you can to take the precautions, limit the activity to something where you're more comfortable with that risk, or you share the risk. You buy insurance. So when something happens, right, the insurance will cover the majority of the financial liability, and you cover a portion, right? That's your deductible. So, what insurance does, that helps you transfer financial risk. And that's for the property. Yeah, the next slide. Sorry. Right. So property hazard insurance, right? That's the owner's coverage against financial loss for damage to the structure, right? As a result of acts of God, theft, vandalism, fire, and other events, right? As the result of an event. So that means there was a lightning strike, there was a flood, there was a fire, there was, criminal damage, vandalism that occurred. Typically doesn't cover wear and tear. So that 35-year-old boiler that finally gives out, excuse me, it's most likely not going to be covered by your property insurance, right? Because it wasn't that a car came crashing through the building and took out the boiler, right? It was just wear and tear. There wasn't an event there. Liability insurance, right, is coverage against losses resulting from bodily injuries at the premises, right? Slips and falls, right? This is actually probably one of the most common claims for property owners, against the property owner's insurance. Somebody slipped on the sidewalk. Somebody slipped in the lobby walking into the building because it was wet. Liability insurance for any residential services that you have. Automobiles is somebody on as part of your board, or if you have employees, are you moving people around back and forth in the operation of your business? And then liability insurance for your third-party contractors, where actually you want your third-party contractors to carry their own liability and workman's comp insurance, workers' compensation insurance, before they come onto your property. Next. Okay, so laying out the budget, this is mostly how it's going to look. You're going to have your revenues, all your gross potential income from your dues, your fees. If you rent parking spaces, you have income from a billboard on the side of your building, right? All your revenues get added up at the top under revenues. The next step that you list are your expenses. Everything you have from maintenance and repair, utilities, your scavenger service, property taxes and insurance, legal and accounting services, any administrative costs. Is there a telephone? Is there, for the property, any supplies that you use for the property, and your miscellaneous expenses. So you add up your total revenue, subtract your total expenses, and that's where you come up on your net operating income. Okay. Your net operating income, then, once you pay, your capital reserves, and then you pay your loan, your debt service, is going to be your net income. And your capital reserves is that pot of money that I mentioned that you're putting aside for future capital improvements or replacement of major equipment or repairs of the structure. That's a separate account outside of your operating account. The items in here on your revenue and expenses, that makes up your operating account, your operating income, right? Your other account is going to be your reserve account. And then what is that for? So let's go on to the next slide. All right, capital expenditures are different from your operating expenses because capital expenditures do not recur. It's not every month, right? Like you could see right below, operating expenses are daily, weekly, monthly at regular short intervals. Capital expenditures typically are every 5, 20 years or more, right? It's when that boiler goes out, right? It's when it's time to replace the roof because the shingles are starting to break off. And it's time to just redo the whole roof, better than just patching it. Capital expenditures are also differently treated for taxes, right? Capital expenditures are depreciated, the depreciating assets that get that are considered the capital expenses, and your operating expenses are deducted for tax purposes from income rather than depreciated. Next. Escrow accounts and reserves. So besides the replacement reserves, there's other types of escrows that can be put together, that can be money set aside for specific purpose, right? It enables the owner to prepare financially for larger expenditures by putting aside smaller amounts in a separate bank account, right? It prevents the disruption of cash flow when the time comes to pay, right? Your replacement reserves, paying for those, the eventual wearing out of the short-lived assets, everything we just talked about, the capital improvements, the capital expenditures, and property taxes. You could accumulate funds until the bills are due, right? And put aside a separate property tax escrow so that you don't accidentally spend that money and then the tax bill comes up and now the tax, there's not enough to pay the taxes. So you want to make sure you start putting aside some funds for these different events. Next. Capital repairs and improvements. Planning, right? Compile that list of those systems and those components that will eventually wear down. And get and you have a sense in your own building, right? What's old enough that you're starting to see signs of failure, right? Regular repairs that are needed, right? Replacing parts here, another part there. Calculate, once you start seeing that, then okay, we need to start planning for this replacement or for an improvement here. You calculate the estimated useful life of systems and the equipment, and you identify the replacement date. So more or less, you can have an idea when you're going to do this replacement. Estimate the cost to replace the item in today's dollars, and then determine the cost of what it may cost, what it may cost in the future when it's time to get there, right? So you're going to kind of project an inflation rate to the time when you're going to plan the repair. Next. Here's a sample page, right? Fannie Mae has this useful life tables, kind of an approximation of how long certain systems are meant to last or can be expected to last. And you could see, catch basin, 40 years, right? Compactors, 15 years. Dumpsters, 10. Those get banged up a lot. Dumpsters, enclosures, fencing, 40 years. Wrought iron, 50 years, right? And you'll see that that very first one, basketball courts, has a very different useful life, right? Depending on the use. So at a family development, you can expect 10 years more of wear and tear in a family development versus an elderly development. All right. For the most part, all the other systems are the same, whether it's a family or elderly development. But this gives you an idea, right? And the thing is, one of the other items that I've noticed is that a lot of the older systems, right? They've made it this long, right? They've lasted. And then many times a newer system, its life expectancy can be expected to be much less than an older system. And that says a lot about, the quality, but it also says a lot about maintenance and keeping up with your equipment and your systems, right? Giving everything that proper maintenance that it needs to have that longer useful life. And it's a cost while you're going, right? It's an operating expense to have maintenance done. But I think that in the long run, it comes out cheaper than having to replace the system every so many years, right? If you can make your systems last longer. Okay, next. Next. Right. And asset management is the long-term strategy, right? You want to ensure the compliance and effectively manage your physical, fiscal, and social aspects of the portfolio over time. This is the long-term piece, is the asset management versus property management of the day-to-day maintenance. Next. All right. And the questions to think, right? In the long term, is the property achieving the mission? Is it advancing the mission? Are there risks or problems now that weren't initially anticipated? Have you noticed any new trends or performance indicators over time? Are we financially healthy? What are the problems or risks to that stability, to that financial stability, and how can we address them? Is the project properly maintained for decent, safe, and sanitary housing and to enhance the neighborhood in which it is located, right? And is the project operating according to all funders' regulatory requirements, applicable local, state, and federal requirements, right? Somebody mentioned earlier that their place, it's a great place to live, right? It's a great property. It was built well, right? And I'm guessing it enhances the neighborhood, right? Because if your property is not doing that, if your property is the one that everybody in the neighborhood says, oh, it's that building, oh, they live over there, right? You want your property to enhance the neighborhood, to be part of the neighborhood, to be a positive member of that neighborhood. So that's also important in the long term, right? Where do you want to be in the long term? Where do you want this building to be? Or how do you want it to be known? Next. Tenant satisfaction, community reputation. Okay, same thing. And just some of the difference, right? The day-to-day, right? And the long-term items. And then somewhere in the middle, there's a few, that could kind of be handled either way as a long-term or a short-term or like a medium term. But key in there is your capital plan, your annual budgeting and your capital plan. That's important because that's your budgets, right? That is your planning. That is your forecasting. That is stating that you're on top of things because you know what's coming up, right? You're not going to get hit with surprises if you're doing your annual budgeting and you're doing your capital plan for the future, for your big ticket items, right? Next. And then just some of the, some quick formulas, right, to measure performance. And it's your operating cost per unit, which is basically what are your total operating costs? What are your expenses, right? And how much does that break down by the number of units? So it's just your total operating cost divided by the number of units gives you the cost per unit, your operating cost per unit. And you can use that, right, on a year-to-year basis to understand, how can we control this, all right? How can we get our costs down? And it's by understanding what's in your budget. What are you spending on, right? And if operating costs go up, why is that? Because you have new systems, because you have new vendors. Maybe it's time to start shopping vendors if your costs are, continue to go up. Okay, next. Your debt coverage ratio, right? This measures your property's ability to cover debt from operations. So it's just your net operating income. Remember, it's your revenue minus expenses equals your NOI, and then your hard debt, which is your principal and interest. Okay, so NOI divided by hard debt equals the debt coverage ratio. So what does this say? 1.22. It says that your NOI is 1.22 times more than your debt. It gives the bank an assurance that you have income that can cover the debt. Now I'm going to ask a question here, and just feel free to answer. You don't have to raise your hand, just chime in. What if the debt coverage ratio equals 1? What does that say?
It's really just breaking even.
You're just breaking even. Yes. Your operating income, that means a debt coverage ratio of 1.0 means that your net operating income equals your hard debt payment, your principal and interest. So you're making just enough money to pay the mortgage, to pay the debt. And what if your debt coverage ratio is less than 1? It's a 0.97. Does anybody say what that is? What does that mean?
You're not bringing in enough income.
You don't have enough income to pay the debt. That's right. So the higher your debt coverage ratio, the better financially that the property is doing, because you're able to cover that mortgage payment at a better, with a better cushion, right? So the higher you are from 1, higher up, the better you are because you have more of a cushion to cover the mortgage. I saw a question, what's a good coverage ratio? Lots of times that depends on your bank, what they want to see, right? I know, like with public funding, IDA, they usually like to see about a 115 minimum. Now, some places that are less risk averse, some private funders, do want to see like a 1.2 or a 1.25, right? And it depends, right? It's just it's a measure to see where you are. But in some places that it would be a requirement that you meet a certain minimum debt coverage ratio through your operations.
I have a quick question.
Sure.
And because I really want you to repeat this again. NOI is your net operating income, meaning this is the money that the association pays because they're getting assessment. It might be laundry room and other fees like that. That's all of the income that gets collected, right?
It's your revenue. So that would be the revenue, the income that gets collected.
Okay.
Right? From the fees, from the dues, from the assessments, if they have vending machines on property or a laundry machine, right? All of that would be the revenue. Your net operating income is your revenue minus expenses. So all the money you bring in, minus your landscaper, minus your people's gas, minus your ComEd, right? Minus all of your expenses, your revenue minus expenses is the net operating income.
Okay.
Okay.
And then one then divides it by hard debt.
Which is hard debt would be your principal and interest payment. What is the amount of your principal and interest payment?
So let me expand that question. So a cooperative has one PIN and they may have a mortgage that they have to pay because they bought a building and created a cooperative.
Sure.
So they might have a mortgage, right? What would you say, what would be an example of hard debt for a condo? Would it be a loan that they have gotten in the past, or what? What would be a debt for a condo?
It could include even like sometimes condos will have those special assessments
Mm-hmm.
to take care of certain capital expenses, perhaps. So there might be a loan, for those types of items.
Okay.
And that could be something where you want to cover, you want to see what your debt coverage ratio is.
Okay.
Taking in again all the revenue from fees, from the HOA, from assessments, minus all the other expenses of the property. It's kind of looking at how much do you have available to pay a mortgage, right? And that can also be used not just as you're paying, but also to qualify for the loan. Because if you don't have enough income to pay a loan, you're not going to qualify for that loan. Does that make sense?
Yes, it does. Thank you.
Mm-hmm. They're going to look at what is your NOI now before we qualify you for a loan. And then once you have a loan, right, it's a way to see how well are we doing, right? How long can we keep paying this mortgage? And this one's pretty good. 122 is pretty good. Next. It's kind of cut off, right? And good asset management begins early, right? In the pre-development, when the co-op is getting started, right? When the condo association, right? When the building is built and the condo association is created, encourage board members to take a governance course, and not just on the governance, right? But on the financial aspects as well, with formal plans and systems in place, budgets in place, accounts in place, bank accounts in place, and stay on top of the numbers to catch, right, those trends, find out those trends as soon as you can so that they can be addressed as soon as possible. And the amount of time for ongoing asset management increases as the portfolio grows. In some cases, co-ops create more, have more than one building, perhaps. And it would be more important, it's more of it's a bigger job once you have more properties, right? And maintain your property management. Okay. And just continue to monitor all those activities, all those numbers. Okay. And now let's see. There was a sample. Do you have that up, Dana? The
Yeah.
template.
Let me pull it up. Give me 2 seconds.
Yes.
And everyone, please, I know there's got to be some question popping in your heads. Feel free to pop them into the chat. We love to do our frequently asked questions, and we will share that. If we don't get a chance to answer your question directly, we will then, of course, answer it and put it on the link tree so you could have access to everyone's questions and the answers that we've provided.
Eleazar, you're muted.
Okay, sorry about that. So, so the budget is up. So, again, at the top, we start with the revenue, right? What are the association fees? They include in here the number, the reserves. They subtract it out of the revenue. I'm trying to scroll. I'm sorry. No, I can't. I'll ask you to scroll, Dana.
No worries.
I tried to do that remote and it wasn't. I couldn't get it.
I thought
No,
I'd try. No worries. I can
yeah,
speak for you.
I tried that. It wasn't scrolling. So, the reserves, right? Based on the number of units, how many, what are the fees that you are collecting? What are the dues that you are collecting? All of that comes in. You'll see interest on bank accounts is here. And whether you do it as on a monthly or on an annual basis, um, any calculations are the same. Just be consistent and know whether you're looking at monthly numbers or you're looking at annual numbers. But anytime, those calculations, those numbers will work the same, whether it's monthly or annual or even quarterly. So you add up all your revenue, that's everything in the green, right? And you end up with a total operating income and your total revenue. So keep scrolling down. You'll see some more, of those expenses broken down, right? Cleaning and maintenance. You've got scavenger, which is your garbage removal, janitorial. So cleaning the hallways, wiping down the doors, picking up the garbage around the parking lot. You have your lawn, your landscaping, grass cutting, maybe spring plantings, for some property beautification. Extermination could be preventative, right? That's probably the best way to go, is preventative extermination rather than waiting for an infestation and then actual treatment. Snow removal, supplies for the property, general repairs. All right, so you can categorize your expenses in different areas. So this was your cleaning and maintenance. You have a line for property taxes. Insurance costs, right? For your association insurance to protect your members. Liability insurance. Again, remember what's the top claims that are made with liability insurance? Slip and falls, right? And how do you prevent slip and falls? Maintenance, right? Make sure somebody's out there salting those icy sidewalks, mopping up that wet lobby floor when it snows. Okay, professional and administrative expenses. All right, I mentioned legal, accounting, property management. Are you hiring a third-party property manager to handle the day-to-day, expenses, to handle the day-to-day work orders or calling out for vendors and managing the vendors coming? Accounting fees, who's keeping the books, right? Bank fees. You have a couple of accounts at least: your operating account, your reserves accounts, any software, right, to maintain your records, if you're paying any fee for that. And then here you see, right, your total income and your total expenses, right, from operations. It's going to be your net operating income, your NOI. So all of your income at the top, the $3,168 minus this $800 of expenses, gets you to your NOI, your net operating income. Okay, whether it's, again, you got the monthly on the left, you got the annual on the right. And you could do this, month by month. Have a column for January, one for February, or have two columns for January, right? What was your projected and what was your actual, right? What they have here. And then what's the difference, right? Your variance. How far off were we on the budget, right? And then you could see annual, year-to-date actual, year-to-date budget, year-to-date variance. How far off were we on our budget versus our actuals?
So
Right.
we have a question in the chat. It says,
Yes.
what is a good percentage for the contingency budget line annually?
Contingency for, I guess, for maintenance or for, typically, like, your contingencies is based on a project basis. I think that once you're up and running with your budget and you're following and you're tracking actuals, that you really wouldn't need a contingency, right? This is your budget's a forecast. So you can really put, whatever amount, I guess, in the beginning that you're comfortable having, right? But on the other hand, you don't want to collect more from your members, from your owners, than you need, right? You can have a bit of a cushion, and if you do it right, okay, so the cost didn't go up as much as we thought it might, right? You'll have some extra cash at the end of the year, perhaps, and you can adjust your budget, right? But I don't know that you really should have a contingency in an operating budget.
Eleazar, if I may.
Yes.
So for condos, what I would say is that a contingency in the budget, usually I've seen different condo association use the word miscellaneous, right?
Miscellaneous. Mm-hmm.
So contingency on
It
miscellaneous is about the same, is kind of the
could
same.
be, yeah.
Yeah, it's just like that cush that they're looking.
Mm-hmm.
But
Right.
how you get to that cush, right? And what Eleazar is saying is it's based on trends. If the trend is that you're always calling the HVAC guy for an emergency, as opposed to a planned fix or a planned update, or right, it's going to cost you more money because they tell you right away. Just to show up to see what the problem is, it's $120 an hour,
Mm-hmm.
right? And so if that is the habit of your property, of how the asset is being managed, then you better definitely put that contingency there. If you have an old elevator that keeps breaking down and you recognize, right, that it is always pushing you off budget because for whatever reason, the property manager or the board decides it's cheaper right now in the present to pay that $3,000 outside of the maintenance plan that you have with the elevator person, as opposed to trying to raise the $300,000 to fix it.
Yeah.
So those are the things I would say
Mm-hmm.
you can see as a contingency in a condo.
All right.
And or a cooperative, right?
Yeah. And I guess what I'm saying is, like, know your budget, right? Know your building, know what it is that you're spending on. Yeah, and I see comments also in the chat. How do you present to owners when you do not have a balanced budget and you don't have a reserve, right? Likewise, how do you explain what you're doing with all this contingency that you're collecting when you don't always need it, right? So the better you know your property, the better you know your expenses, the more on target your budget's going to be, where you won't need as much and you can build in by line item a contingency, right? You know that your plumber's coming out every month. There's always something happens every month for $100 a month, and but he may raise, we've been paying $100 a month for so long, he may raise his rates soon. So you could put in a cushion, right, in case he does raise the rates. You could put in a cushion, right, of certain things that you anticipate may happen, right? But that cushion you can put in there, but it's probably better itemized rather than just a general miscellaneous line or a contingency line.
I just have a clarifying question just for myself, learning minds. What is the difference between that and having a really robust reserve account?
Your reserve account, it has that capital plan, right? What you're putting aside is for things that you're expecting to replace. Now, it could be something totally unexpected comes up, right? But you do have that cushion. And it's really for those certain items that can be depreciated. Your big ticket items, right? Your boiler, you're replacing the roof. It's something that can be depreciated versus, the replacement reserve account is not because, your expenses went up,
Mm-hmm.
right? Because the cost of, waste management or flood brothers went up,
Mm-hmm.
right? Your replacement reserve is for capital improvements.
And I'm sorry, I do have to repeat that, right? Your reserves is not to balance
Your budget.
your replacement. And I know there are members here and board members here who have addressed this, that have said, well, we've got 100,000 or 800,000 in our reserve fund, right? Why are you doing an increase on our assessment? Use that money, right? And then you have the board who don't really understand their reserve plan because they may not have one, don't understand a reserve plan, and are unable to say, in year 2 of this moment, we're either going to have to raise $1 million through special assessments or have enough in our reserve to address it and or get a loan.
Right. And there's different types of reserve accounts, right?
Mm-hmm.
I only touched on mostly the replacement reserves for your capital improvements, but I did touch on other escrows, like your property taxes, which year to year or every 3 years are a complete unknown until you get the bill, for the most part, right? For many people. So you can create an escrow specifically for property taxes. You can create even an operating expense reserve for those shortfalls, right? Because it's related specifically for shortfalls. But again, it's not meant to be drawn on every month to make up for those shortfalls. That's supposed to be for one time, even though that one time may last a couple of months because of some really unforeseen circumstances, where you would have to draw from your operating reserve account. But there's different types of escrows, different types of reserves that can also be set up, but know the purpose of them, know why they're set up and what they can be used for.
Eleazar, I see a question here about condo law. I thought requirement in relation.
Requires reserve.
Carl, can you help us?
Requires condo assessment or reserve funds to
Yes,
protect.
well, yes,
Okay.
it was a comment that I received, and I was questioning if condo law requires a reserve.
So the Illinois law says that the Board of Managers have to, right? Not may, not could, right? They must, M-U-S-T, right? Do certain things. And so one of them is you got to do a budget, and the budget should show some level of reserve. The norm on reserves, I believe, and correct me if I'm wrong, Leroy, Eleazar, of course, is I think it's 10%. That's kind of best practice.
Yeah,
Some buildings go
budget shows
higher
10%.
because they're older buildings and have to keep some kind of historical blah, blah, blah. Can you confirm?
Well, I'm looking. Crystal put in the chat, right?
Yeah, I see that.
You
But
see that,
I would.
and what I say there, yeah, I do want to confirm this amount. But even here it says that it's for the replacement costs.
Correct.
Regarding the useful life of the property, right? Should consider the useful life of the property, right? Should disclose the status of the reserve fund right? Not just to potential buyers, but to, current owners as well,
Mm-hmm.
right? So again, it's saying create that reserve, but identify what you're going to use it for.
And I think
That's
that's key.
that's the point I kind of want to make for the different types of reserve accounts that you have. Whether it's for property taxes, everybody should know that's for property taxes only. And that's the only time we should be withdrawing from that account. For replacement reserves, it's only for replacement reserves, capital improvements, capital repairs, and that's the only time we should be making any withdrawals from there. You can create an operating reserve account, right? But then, identify how it can be used. What are the circumstances that can trigger withdrawing from that operating reserve account?
Okay. So, Eleazar, before we close this part of the session, because we're going to take kind of some of the stuff you mentioned and shared with everyone and put you guys into breakout rooms and do a bit of planning for your new co-ops or new condos. And so, Elisa, before we end this session, what didn't we ask about today? Just question mark. And then what would you say about whatever that is?
I don't think, well, we haven't talked about, right? Alternative resources, alternative, right? Funding that can be tapped into, right? The budget, you're really talking about it. It's an internal budget from among the members, from among the owners, that can do that. And in many cases, especially for capital improvements, there could be other sources of funding. Loans, right? Home repair loans, and even tied to that, there could be government grants or lower interest loans or other resources that can be used in combination, right? With the bank loan, maybe a City of Chicago loan at a lower interest rate so that it lowers your combined interest rate together. There may be grants and other resources that can supplement a budget.
Thank you. Thank you. And actually, Dana, I hope you took that in mind, because it'd be great to do a roundtable on what are some of the other resources that's potentially available for properties and what would they require to access those programs. Okay.
Awesome.
Awesome. So next steps, Dana?
All right, so next steps is we're gonna do some case studies. I have 4 different case studies. I have 2 co-ops and 2 co-ops and 2 condos. And I already pre-assigned everybody to some rooms, and you guys are gonna go into these rooms, review the case study per the room that you have been assigned to. I put in the chat the link tree to be able to get to those case studies. If somebody needs me to email it to them, feel free. I can do that for you. Just let me know. And we can get these case studies started in the breakout rooms. We're getting everybody coming back in. Got another 15 seconds so everybody comes in. I hope you guys had a great time thinking and strategizing on your plans and relating them back to maybe some of the things that you go through.
We can get that money. Okay.
All right, and I know that we said the presentation had to be 5 minutes. If you guys don't make it 5 minutes, that's okay. All right. All right. So our first case study was the Granite Co-op. Did you guys decide on somebody to present for you, or is there anybody that wants to talk about what you guys talked about in your breakout rooms?
We didn't do that.
Someone is.
Who was the presenter chosen or the scribe?
That's
Or if
for,
you just want to jump on in for case study number 1, Granite Co-op.
was that us?
No,
Granite
we were
Co-op?
TID.
Yes.
Yes, Mark Willis, you were in Granite Co-op.
Oh, okay. I'm sorry. Annie, could you go over again? It was rising costs. Rising costs of 15%. There were certain things that we had to actually do. We had to balance the budget, manage unpaid fees, and show some form of transparency.
Right.
No.
So basically, we had a total of 100 units that we said that had a revenue of $1,000 per unit. That was their mortgage or that was their HOA fee. We did have some other additional revenue coming in from parking as well as laundry service. The parking came out to a total of 10,000. The laundry service was a total of 8,000. So our total income, or shall I say total revenue, was a total of 118,000. We did have recurring maintenance fees monthly. For maintenance was 500, security was 500, janitorial was 250. Incidental for plumbing, emergency for plumbing and electrical was $1,000. Our property taxes came out to $1,000. Administration fees that were monthly was $2,000. The utilities was $20,000. $2,000. Insurance was $7,000, as well as our trash was $1,500. And the total for our expenditures came out to $14,750. And subtract that from our revenue, came out to a total of $103,250 net operating expenses. We were in the middle of discussing how we can actually obtain the unpaid mortgage for 15 of our owners, of which we hadn't really got an opportunity to really discuss that in full detail, but we were making some suggestions about them actually trying to make some form of a payment.
Okay.
Anybody can chime in and help me with this?
Anything that Mark missed or you guys didn't get a chance to tell Mark to report out on? Anyone?
A potential debt recovery agency.
Debt recovery agency, okay. To get from the owners that have not paid as of yet. Okay. All right. All right. For this group, let me ask you, in working as a collective, what was the most challenging thing?
Well, for me, it was trying to assign figures in a fictional kind of way, not having a concrete answers to what money we were playing with and what kind of revenue and debt we were talking about. That was a little hard for me to imagine. And I think what it did is there was a lot of agreement among us, but I think it also produced a situation where people were kind of not sure whether they were agreeing or disagreeing over certain numbers.
So if I may repeat what I've heard or define what I heard is know what you know. You don't know numbers, you don't know certain information, you can't really pull a plan together, can you? And so make sure we have good information, real information, accurate information if we're going to talk about a plan. And then in engagements, we become debaters as opposed to resolution. And so that's because you want to agree to, you don't want to disagree, you don't want to agree, or you begin to debate. That's just our human nature. And so again, a workshop we hope to have is listening to gain information, not listening to respond. listening to gain information, not listening to respond.
Hmm.
And then the last thing I will say is, especially for owners, for the members or the shareholders in a condo co-op association, it does take courage. It takes courage to say candidly, well, listen, Janae, I don't think that's going to work for us. I do understand we have people who are on fixed income. But first and foremost, we have to balance what's occurring. I may be all about seniors and don't want to hear nobody else talk about seniors. And we should cut their assessment, but the law doesn't say to do that way. So that's kind of what I'm hearing, that your group dynamic was such that you kind of agreed, but kind of didn't agree, but you agreed that you didn't agree, but really didn't come up with a solution. But definitely came up with, we're challenged because we don't have sufficient information.
True.
Anything else this group would like to add?
We didn't get into transparency, and that's another thing, actually, to convey to owners transparency.
Anyone in your group want to expand on that? In Mr. Lee's group? Transparency? Ladies and gentlemen, transparency is easy. Go ahead, Dr. Keelan.
Excuse me. I feel that transparency is very important, especially to the share share owners. I feel that we should be as transparent as possible because people want to know, and it's a human nature of people. They just want to know where they're going and how much and how is it going to affect them.
Thank you, Dr. Keelan. And I will say transparency is easy, right? As long as you're transparent and holding confidentiality, condo co-op, townhome association, confidentiality is key. And again, we're going to go deep into that confidentiality piece. But transparency means that people have access to facts, not opinions, the facts of the budget, the facts within the industry, the facts with the work that you got to do, and that it is shared. No matter what you fear, that I'm not going to get elected again, or people are going to say the board is not doing their job, or why is there an Amazon bill on the thing, right? If you give people correct, detailed, factual information, then at the very least, you have given access, and then it's up to the human beings, the adults who are part of that community to choose to read. And then to choose to ask a question as opposed to just, doing the gossiping thing or the chisma thing within the community that builds dissension. Eleazar, with this group, I don't know if you had a chance to look at the case study.
I believe Eleazar was in this group. Case study number 2.
Okay, good.
Yes,
So,
I was in case study number 2, marble condos.
Perfect.
And so we had a lot of ideas, but I don't think we nailed it down to what our group response was. So I was the reader by default. So would anybody like to report?
I
on our
can
findings?
report. My name is Akila Hill. I can report.
Yep. When it came to because we had a shortfall of 10,000, but we had 3 owners who were collectively 18,000 in average of their assessments. So one of the suggestions was to have lien letters go to them so that we can start getting collections on those average of assessments to try to help with the shortfall. The other ideas was to stop vendors to get lower costs for maintaining the property. Then we had a couple of ideas of trying to bring in some extra revenue. Someone suggested a billboard on the building. Then there was idea of, not knowing really if this particular property of 15 units actually had a laundry room, because that would be possible revenue to come in and try to offset those, the shortfall. But that was the discussions that we had. And like the reader said, we never really just kind of decided on one particular thing, but those were the things that were presented for our group.
Okay. And like I asked the
Very good.
Does anyone want to add anything that may have been missed?
There was a few more other suggestions as well. For in terms of closing the $10,000 deficit, it was suggested raising the assessments by $55 per unit. In terms of the collection action, it was also suggested to encourage a payment plan with delinquent owners offering a third paid up front to hold off on any collection actions. And then it was also suggested to refer delinquent owners to different housing and budgeting agencies.
Okay, thank you, Ms. Director Hill. Any other points? So I'm going to ask the next question. You're a group of strangers having to plan with and for each other with limited information. What was challenging for you?
Well, I think, oh, go ahead.
No, go ahead.
Yeah, I think one of the challenges is that you try to come up with solutions when you really don't know your audience. You don't know who are these, people in your building, right? So now you're trying to decide, okay, do I increase an assessment by $55? How is that going to impact the people in the building? Am I going to create another problem? So that was one of the challenges. The other challenge was really having people listen for information rather than, combating each other because there's some idea or something that's presented. So I think that's one of the challenges when you're working with people that you really don't know and being in a position to listen. Those are my comments.
Thank you, William. So it sounds like you guys had a nice, good, long conversation and had some ideas about how to meet your plan, your needs. But like we all know who've seen boards talk and meet and seen, come to annual meetings and everybody's kind of talking at each other and saying, I'm actually talking to you. Again, I'll repeat, we have, as human beings, we need to begin consciously to listen, not to respond, but to gather facts, right? And I will tell you, when I do the training with boards on mediation and owners on listening, these properties become more cohesive. We're not saying kumbaya. We're saying cohesive in that it is recognized that the shortfall of one will fall upon all of us. So if you're raising assessment and you have people who are not able to pay that assessment you're raising, you're creating a collection situation, you're creating a habit you don't want to continue. And so we're not saying you got to know everybody's income, but as board members or the fiduciary responsible people, the governance, there has to be some understanding of who your community is. That's part one. And CSO always advocate that you do an individual owner's assessment, which is a tool that we use at CSO. The second thing that I would say when you're thinking about getting to know the body, it's a double-edged sword as well. And that double-edged sword is, now that I have knowledge, and sometimes more intimate than I want to, I know your son is ill, I know you're just, all that stuff. It weighs on you as a leader, especially if you're within governance. So understand when you're at that governance table, it's about everybody and creating the best balance possible. Because as much as you may want to save somebody and say $55 is too high, I know 3 of the owners that won't be able to pay that. You're also saying that you expect everyone else to carry those 3. Who's missing, Dana? Next.
We're coming to the end, so I would say if group 3 or group 4, if either one of you guys want to present, and I think that could be our last.
We had the Onyx group, presentation 3. We didn't get very far, but within our presentation, it was dealing with the management company being unresponsive. And one of the suggestions was to fire the management company because they weren't being responsive to the needs of the community. And they weren't answering, or being held accountable. And so one of the part of that conversation that we started to have was that perhaps as we would vet for new companies, and that's a process because you have to get proposals, you have to look at them, you have to make a decision. But while you have your current management company, create a performance improvement plan and put time limits on or expectations on what they do is like a shorter leash while you're still looking for new management companies. And that's about as far as we really got as far as our group.
Thank you, Director Alston. I saw a bit of that conversation. It was pretty lively conversation and planning. And what I heard is Director Austin and her group was saying, yep, we'll get rid of them, but we got to make sure.
No.
Right, but we got to make sure we know what we're getting into. So create a moment that is clear with the property manager that they had some shortfall that they need to fix. And then, right? Once you are rolling and you know there's others that you could hire or are interested in working with you, you then can continue because many management contracts have a pay to get out if you're going to get out prior before the time. So what I heard Director Alston and her group did was really think it through and say, are we just going to yell breach a contract and throw out the baby with the bathwater? No. We are going to try to create some order where we can with this management plan and that they need to meet, while the board and governance look at other opportunities and bring in another company if necessary. Some may say, better the devil you know, and give them that management plan. And if they don't meet it by the end of their contract year, then you just move on to someone else. Okay. Any other thoughts from the group or anyone in general?
I have a question. I was just listening to the very last one. What about the loss of the 150,000? Would that go to a lawyer? Or would you file a lawsuit? I mean, how would that situation be handled?
Right. It all depends. Some associations write it as a loss in their books because, you can. Your CPA could tell you how to do that. Other association actually utilize, if again, they have the right insurance policies, may look at the insurance policy and see if there's a gain there. If they could get something back. Understanding that if the insurance policy hire their lawyer and find that the board member or the vendor or whoever it is that was sneaking out that money is guilty, then, you know, you got to ball up and say, okay, we'll go the route. You can't just say, oh, no, 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 we don't want to put Janae in jail. No, Janae was taking it, and there's proof. Janae may go to jail, point. So understand that everything has a consequence. But this is the reason that planning and transparency is clear. While the board members are in the weeds about things, trying to make sure it works, sometimes they do need you as the shareholders and the members. This is why we're not saying this is a board training or anything like that. We want members to recognize when something goes wrong in your property, while you're pointing to this elected board or the property manager or whoever you want to do the double point, your thumb is looking at you. And the question is, what was my role in this? Was I paying my assessment on time? Yes, no. Did I join and engage to provide insight without being disrespectful and bullying everybody? What is my role in this? And for those that don't want to join the board or engage so actively, your participation is key, because a zero may drop off and you have the proof that last time you gave us paperwork, that zero was there and this zero dropped off. Yes, the treasurer should have caught it, but the treasurer is a volunteer and they didn't catch it. This is why it's a collective, it's shared ownership. The board is there as guardrails. Your bylaws are there as bumpers. Your eyeballs, your connection to your investment, that you call your home, and potentially your investment legacy to the future, is also your responsibility. But if we enter these meetings and we're asking questions as though everybody's a thief, then yes, people are going to fight back. But if we enter meetings and say, I need to have better knowledge, why did that zero drop? Well, you know what, Mr. Jackson, I don't know why it dropped. I will look into it as the treasurer and get back to the membership, not just to Mr. Jackson who's asked the question, to the membership. That is transparency.
Yeah.
And Mr. Jackson was right. I did take that $150,000 and spent it with my young boyfriend in Mexico. Anyway, I want to, Dana, did the poll go up?
I did. I put the poll up.
Okay, the poll is up. We are doing these set series little by little, really wanting to get shareholders to attend, right? And in doing that, what we hope is that shareholders and condo members understand how much work it really takes to make these decisions. Because you're making decisions with other people's money, right?
Yes.
Point. And we have to respect that. And so we're hoping that it helps motivate not only here's what I know, but also motivate here's what I'm not sure of, and attend these sessions and hopefully you get some answers. Everyone who attended, who registered, is assumed to be interested in the next session, and they don't have to register again.
No, if you've registered for past events, you'll be able to get in. I'm gonna not do the registration via Zoom anymore. You'll be able to get into the next session without having to register.
Thank you.
Okay.
Thank you.
And then, as we said, everyone who did the breakout, now you know how to get into our information link tree. And so from time to time, we'll send you a note and say, click on the link tree. We got new
There's
information.
updates, yep.
Yes. And I'm going to tell you how new information gets in the link tree. Sending questions to info. If we get 3 or 4 people saying, you know, what does it mean to have, I don't know, property tax? I'm a condo, right? Some condos do property tax because they own a piece of land that has its own PIN, right? That you got a garden on it. I don't know, right? And so, if we have 5 people asking that question, we may pull a workshop because we believe if you thinking it, there's a bunch of people thinking it too. So we'll be doing these ongoing, and we hope that you continue to participate, check the link tree, and please, 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 for our funders, which is the City of Chicago Trouble Building Initiative, and some foundations, some private foundations, we always want to show them what worked and what didn't work. And hopefully that helps us be better information transfer to you in the future. Thank you all for coming. I hope this was worth your evening.
Thank you.
Thanks,
very much so.
everybody.
It was very
Thank you.
enlightening.
It was very informative. Thank you
Thank
very
you,
much.
thank you.
Have a good
I put some resources in the chat as well, so you guys check that out. I have the lie heap from CETA. I'll also be sending out emails, and it's just a resource for everybody. Feel free to share. They got some more money. Let's get that money.
That's right.
Thank you.
Okay.
Have family and friends,
Everybody.
let them know. Yes.
Thank you. This was a good session.
Thank
Thank
you.
It was.
Thank
Good
you.
night.
I enjoyed it. It was
Thank
very
you.
Thank
Good night.
you. Feel free to put your email in the chat if you'd like to contact us. Okay. I saw some people were interested in the survey, so I'll be reaching out to you guys. Okay.
okay.
All
Thank
right.
you so much, everyone.
Thank
Have
you.
a great evening.
And if like the budget template, the resources that we use tonight, we'll put those on the link tree as well once they're up and ready for you guys. Okay. And I'll send out an email
Okay.
letting everybody know when they're ready.
Thank you.
Thanks,
Thank
everybody.
So
Thank
thank
you.
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 And
All
everyone.
right.
you.
Good night.
Good night.
Thank you.
Night.
Thank you, Eleazar.
Thanks, Dana. Thanks, Janae.
Good night.